Good evening to all. Today we are going to see about public deposits. So, first one, public deposits. Public deposits are unsecured, more risky. It is less liquid. Liquid in sense it cannot be easily transferable into cash and without any tax advantage. It has tremendous growth both in amount of public deposit as well as number of companies accepting such deposits for their growth. Growth of public deposits in many companies has been viewed as diversion of people savings in the non-banking sector. So it makes the persons to have their own savings in the other sectors. So it makes the company to have a tremendous growth towards it. And next, we are going to see about a source of corporate finance. So many companies have accepted unsecured deposits from the public, mainly of non-banking joint stock companies, increasing to increase their demand of the public deposits from corporate sector, cost, and we'll be able to see it in the cost of the funds, availability of alternate sources of finance, and convenience in raising the funds. So these are the things we are going to see how they are going to increase their demand in the public deposit. Next, we are going to see about cost of funds. So cost of funds is certainly lower than the minimum rates and cost of funds is the interest rate that the financial institutions are paying on the funds. They use it for their own business. The cost of funding is one of the most significant input for the financial institutions because a lower price would always end up in producing higher returns. So we'll be able to get more profit as funding is most important for important source which the funding has been done by the borrowers for short term and long term loans. So we'll be able to get it from the creditors. So one of the main sources of profit for several financial institutions is to spread between the cost of funds and the interest rate. So it is according to the funds they'll be charging of the interest. So cost of funds demonstrate how much the interest rate of the bank and other financial institutions have to pay to acquire the funds. They'll be first they have to see whether they are able to make the payment of interest. So, so that only they are going for public deposits as it is lower interest when compared to the interest rate given by provided by the banking and financial institutions. So, when compared to the interest rate charged by the lending financial institutions, public deposits are much lower, and it is also risky and unsecured for the corporate sector. Even if it is unsecured, they have a tremendous growth due to the public deposits. And next one is alternate sources of finance. To meet the financial requirements from the bank, term lending from the financial institutions, and new issue of capital. What is meant by new issue of capital is nothing but whether stock or bonds are means for raising the capital for a company. New equity shares are often issued by the initial public offering, that is IPO, allowing the investors to buy the stock of the previously private company for the first time. Whenever they are going for a new purchase of shares, they are called as they will be said to as new issue of capital. So it is provided initially for the public, allowing them to invest in their stock. So bank and other financial institutions insist for minimum margin money, which is difficult to arrange. And it is also large companies will always do not depend upon the alternate sources of finance. So RBA policy always regards on the tandem committee norms and credit authorization schemes which is provided by them. So next we are going to see about convenience of funds, convenience in raising of funds. Already everyone knows about the creditors. Creditors are the person who are going to give the loans to the companies. So whenever the money has been borrowed from some person, they are termed as creditors. So next one we are going to see about mortgages. Mortgages is nothing but is an agreement between you and a lender who gives the lender the right to take your property if you fail to make the payment. For an example, if you have purchased any asset and in that it is called as mortgage. Whenever they have the right to take the property when you are not able to make the payment which has been borrowed from them with interest, they will be taking it. So mortgage are the loans used to buy a home or borrow money against the value of home. When you are keeping the home as a security, so that is called mortgage. So seven things to look for in the mortgage. So there are many things to have to be seen. So they have said that they have the right to take your property when you fail to make the payment. And next one is public deposit has no security and no need of creation of any charge against any asset while raising the funds through public deposits. So thank you. We'll meet in the next class. Thank you all.